our next conversation that we're going to have about time value of money will center around debt securities, investments in debt securities. So remember that here we're talking about investments, which is chapter 12, in case you're looking through your book. We're going to talk about investments in both debt securities and equity securities. Module 17 will be all about debt securities, about the classifications of those debt securities, and about their financial effects of those classifications. Remember, we talked briefly about these at the beginning of the class, long time ago now, it seems like, right? Where we had various classifications of these securities based on our intent. So all we have to do is say, well, we intend on selling these securities for a short-term profit or loss, and then they become a classification called trading securities. We could say we intend on holding these securities until they mature, and then they're held to maturity securities. And then if we don't have one or the other of these intents in mind, then they become available for sale. So, I mean, you can think of it as a spectrum of intent. We're either holding it till maturity, which means that we are not going to sell it, or we are trying to trade on short-term profit loss, or, we want a short-term profit. We're not going to try to trade it on a short-term loss, although that might be what happens, right? So these would be trading securities, and these would be held to maturity securities. Again, the idea is that we're generating profits through the sale, definitely selling. And here, we're not selling, we're holding on to for a fixed rate of return. And that would be the interest. Because remember, if we're holding someone else's debt, it's paying us interest. And in this other category, we might just be playing the market, right? We're hoping that interest rates fall, which means the value of my debt holding will rise, and then I can sell it on the market. All right, and we'll talk more about that in a bit. But these would be their trading securities, and these would be held to maturity securities. And then there would be this vast gray area, and this would be basically available for sale securities. Anything that we're not holding to maturity, that we're not intending on trading right away, falls into this middle ground. So that's basically the definitions there. What can be classified as each? Currently, equity can be classified as either trading or available for sale. Right? I took that X out because there's a new FASB standard that removes the option. And I believe it comes into effect at the end of 2017. So soon it'll only be trading securities that, or equity can only be labeled as trading securities. Right now, they can be labeled as either trading or available for sale, and debt can be any of the three. Of course, equity could never have been held to maturity because equity doesn't mature, right? There's no set date on which we're going to have to sell our equity or that it expires in some way. It's called a financial instrument that goes into perpetuity, forever, so to speak. So looking at the different investments, the different intentions classify it as three different items, and each way of classification changes something about how we record the effects of these items. So remember, now we're locked into debt securities. We're not going to think about equity for a bit. So the held to maturity classification is going to be classified on the balance sheet at amortized cost. And we saw in the notes receivable chapter that that is face value less discount, or in the case of a premium, face value plus premium. So we take the parent account, we add or subtract the contra or adjunct account, and we get the amortized cost. Trading securities are going to be held at their market value. Whatever they are trading for on the market that day is their value. Same story for available for sale. Market value. So even though it's debt, even though it may have a discount or a premium, we still use the market value to value it on the balance sheet, which is going to create another adjunct account so that we can bring it from its amortized cost up to the market value. We'll get more to that in a second. Unrealized holding gains and losses, right? Remember that this is when it's unsold, it's unrealized, we're still holding it. These are the gains and losses that accrue because these items are always changing value. Anytime interest rates change, fluctuations in the interest rate at all will change the value of debt that you can buy on the market, okay? So held to maturity securities, we don't care because we are holding the security until its maturity. We're not going to trade it. They are irrelevant and not recorded. So we ignore them. If there's a fluctuation in the value of our debt investments and we label them as trading securities, then we want to recognize through net income. And if there's a fluctuation in market value and it's labeled as available for sale, we will recognize those in OCI. So our great friends, right, from the income statement are going to come back. Trading securities values will be recognized in net income. Available for sale will be recognized as an OCI item. Other income effects. So the unrealized gain, holding gains or loss affect net income. Available for sale do not affect net income. They affect, they recognized in OCI, which affects OCI. The other income effects that could occur, well, for all of them, we're going to have interest revenue. Remember that this is all debt, and if we are holding someone else's debt, we are being paid that interest. Right. The other income effect is that if any of these are sold, there's going to be a gain or loss on the sale. And any gain or loss on an actual sale, not just a holding gain or loss, will be recognized in net income. So when I say other income effects, I explicitly mean net income, not OCI, right? So let's look at each one in turn. Held to maturity. I've gone through most of this, right? They are recorded as an investment at the face value of the investment. So like notes receivable, we are going to record something that looks just, I mean, and it's going to vary, and Connect will have a different term for it, I'm positive. Debt investment, HTM. Credit, I'm sorry, debit, because it's an asset, and then we're going to record that at face value. We're going to purchase these with a certain amount of cash, and maybe you can guess what that's going to be, right? If this is the FV, then this will be the what I want to pay today for it, present value. And then any difference between those two amounts that is induced by, what is it? The market rate and the stated rate being different, would be a discount or a premium. Okay, so we'll look at that in a second. Remember, we want to report them at amortized cost, ignore the fluctuations because we are holding them till maturity. What are their income statement effects? Interest revenue. And if they're sold prior to maturity, recognize the gain or loss as part of net income. Now you say, wait, you said that you're not selling these, you're holding them till maturity. Well, true. And it's an intention, it's not set in stone. So these things can change classifications. We can sell something out of held to maturity. There are tighter restrictions for investment brokers and the financial service industry because these represent such a great source of gains or losses for them. However, for most companies, there is not going to be a big red flag raised if they sell off some of their held to maturity securities. The cash flow effects are a little bit more intricate. Of course, we're going to have a receipt of cash for any interest payments, but it may not coincide with interest revenue recorded. So we're going to have to make an adjustment to cash flow from operating activities. This will arise with any instrument that has a stated rate that differs from the market rate. So it's either going to have a premium or a discount. When they're sold, they represent cash inflows from investing activities. When they're purchased, they're cash outflows from investing activities. So the cash, when we purchase and sell them, it's going to be a CFI event. But when we have a receipt of interest, what is typically going to occur, as you saw with the note receivable problem, is I might receive cash of $200, let's say, and then I record interest revenue of $175, and then I would have a discount. Sorry, not a discount, but I would have a premium that I'm reducing by $25. Well, when this occurs, right, my revenue is not stating the true cash flow. This is in my net income. Remember, I use net income to figure out cash flow from operations. Well, it should be $25 higher, so I'm going to add this premium to net income to obtain cash flow from operations. All right. All right, let's look a little further now. I say on January 1st, 2016, Chris Co. purchased Strauss Co.'s 1 million par value 5-year bonds. There's interest payable annually at year end at a rate of 9.5%. And the bonds were priced to yield Chris an effective return of 10%. So I have just altered one tiny thing, and that is how I state the market rate here. And it's a more, how do I say, intuitive or rational statement of the market rate, because remember, whatever I'm going to get, my true rate of return or my effective return is going to be the market rate. I'm not going to get 9.5% return on these bonds. The reason why I'm not going to get that is because I'm not going to pay $1 million if they have a stated rate of 9.5%, but they should have a stated rate of 10%. Now, whose 10% rate is this? Is it Strauss? Is it Chris? Remember, the rate, this effective return rate, this market rate, is going to be attached to whomever is borrowing money. Chris is purchasing Strauss Co.'s bonds, which means that Strauss is getting money from Chris and promising to pay it back in the future. So the market rate belongs to Strauss. Other than that, everything's the same. This is my future value. 5 years is my time to maturity. The interest payable annually, this is going to be my stated rate. And the effective rate is my market. So you input future value of 1 million. The payment, remember, is going to be the stated rate times the face value which turns out to be 95,000. And we have I is 10, N is 5. And so now we just have to solve for the present value. The present value of this would be $981,046. That is what I'd be willing to pay today for, and that is actually misprint there, Strauss's bonds. Okay, so what would Chris record? They would record a debt investment, that is HTM, for $981,046. We would have, sorry. That's the amount of cash we would record. We would record the debt investment at its face value. Smack myself over the head. And we would have, in this case, a discount on the held to maturity securities of, in this case, $18,954. So again, we have an asset recorded at its face value. We have what we're giving up recorded at its present value, the difference between them being a discount or a premium. In this case, it's a discount because, once again, we have the market rate greater than the stated rate. So what that is saying intuitively is that they aren't compensating us enough. The true rate they should be compensating us at is going to be obtained because not only am I going to get their stated rate of 9.5%, but I'm also going to undercut the amount that I'm going to get in the future. So what Chris is doing is paying $981,046 today, and they're going to receive $1 million in the future. And this is all ignoring, well, it's not totally ignoring, but that increase is ignoring the amount of interest I get at the 9.5%. So I'm getting the 9.5%, and I'm also going to get essentially $18,954 as added interest. And that added interest will equate over 5 years to get me an effective return of 10%. Right? So one thing I want to introduce here is an amortization schedule. It's very useful. This is another way of working through a problem. So what we see is we have an interest revenue. Remember, interest revenue is going to be the market rate times the carrying value. The cash payment is always the stated rate times the face value. And then the amortization, remember, is going to be the difference between those two. So it's the difference between the cash payment and the interest revenue. Because if we set it up in a journal entry, it was always the plug, the difference between those two amounts. And then that'll either increase or decrease my investment, the amortization, depending on whether I am amortizing a premium or amortizing a discount. So the investment at 12/31, right? So at any of these year ends, 12/31/16, 12/31/17, we can track it over time. This is going to be the carrying value of the investment at those dates. So when we start off, what we would have then is a carrying value of 981,046. I start up here, not on 2016, because this would be the end of the year 2016 when this was issued at the beginning of the year 2016. So this is my carrying value from here. Right? The other way to get the carrying value, remember, is to look at the parent account, which is $1 million, subtract off the contra account, which is $18,954, and that gives me the amount of cash, or the present value, the carrying value. Take that, multiply it by the market rate, which is 10%, would give me $98,100. 105 after rounding. The cash payment, remember, is not going to change. It's always going to be my PMT, which is 95,000. The difference between them is 3,105. And that's the amount, in this case, that I'm going to want to reduce the discount by. So if I recorded my discount initially at 18,954, I'm now reducing that by 3,105. I would have 15,849 remaining, which means now my contra account is at 15,849. If I want to get the carrying value, then I just look at the difference between the investment account, which is the investment in HTM, which is at 1 million. 1 million less 15,849 is going to be 984,151. So that's my carrying value after adjustment, after I've amortized that amount. So I did that with T accounts, but I can do it a little more quickly. If you think of this number as net of the discount, which it is, it's 1 million minus 18,954 at that date. Well, if I reduce the amount of discount I'm netting, then I add to the overall carrying value, right? So I'm reducing this by the discount. I reduce the discount a little here, therefore the carrying value increases. And as you see, 981,046 plus 3,105 gives me 984,151. So this amortization table makes it really easy to go through, and especially with an Excel file, input formulas and then just carry it down the rows and the columns, and it'll give you your carrying value at any year. However, you need to understand where it comes from, because otherwise it's just numbers and formula and mathematical operations. Okay, that's why I introduced the T accounts first, give you this next. But it does make things pretty easy, right? 984,151. Now I'd use that to figure out my next interest revenue for the next year. It would be 98,415 because I just multiply it by 10%. Remember, the cash payment doesn't change. The difference would now be 3,415. That's the amortization to the discount that I would make. And again, I just add 3,415 to 984,151 to get the next carrying value, or the carrying value at year end after adjustment. So that becomes 987,566. And then when we talk about debt, I'll show you an even easier way to get this at any point in time. Maybe you already understand what it might be. At maturity in 2020, we are going to have a carrying value of $1 million. This is always your check figure, because at this point, remember, carrying value equals the future value of my bond because it's matured. Now, not only should you be able to use these and T accounts, but you should also be able to record journal entries from these items. So the journal entry to record the first interest payment, 12/31/16, would be a cash payment to Chris of 95,000. Chris would be able to record interest revenue of 98,415. And we would now amortize the discount by the difference between them, 3,105. So it translates really easily. Just every row, the first three columns are your journal entry, which then this journal entry that you just made creates the next carrying value because it reduces the discount. We subtract that from the face value to get the carrying value of the bond after it's been reduced. Or in this case, after the discount's been reduced, which increases the carrying value of the bond. Okay. Why are we recording more interest revenue than cash? Think about it. We're recording more interest revenue than we're getting in cash because the cash is the stated rate. But remember, I'm not just earning the stated rate. I'm also earning the difference between $1,000,000 and $981,046. The income statement effects are going to just be, in this case, $98,415. We don't have to worry about anything else because it's a held-to-maturity security, and hence no other effects. The carrying value of the balance sheet on 12/31/16 would be the amortized cost of that security, which is going to be the carrying value, $984,151. All right, so then we're going to look at trading securities. Same ideas, a little different reporting. So trading securities are going to be those things that we buy for short-term profit, right? The balance sheet is going to be the face value. We are going to have an investment account. It's going to be at the face value, just like HTM. We are going to have a premium or a discount as well, but we still need to report these at fair value. So that's going to require really 2 year-end adjusting entries, because not only will we record the amortization of the premium or the discount, but also we need to record what we call the mark to market. Right. This will give us the amortized cost, and then we mark that amortized cost up to the market value. More on this in a second. The income statement is going to have a couple of different treatments than HTM. Remember, now not only do we record the realized gains or losses, that is when we sell, but also the unrealized gains and losses and net income. And the answer to why is because we intend on selling these things at any moment, so knowing their most current market value is relevant to investors. We want to report interest received in net income. So again, this is still a debt instrument. So I'm sorry, it shouldn't really be interest received, but interest revenue. Because interest received and interest revenue will not always equal each other. Okay. With regards to the statements of cash flow, they are a little different than HTM. One thing that does not change is the whole idea that we have cash not equaling our amount of interest revenue necessarily, so we have to adjust that in CFO. An oddity of these guys is that when they're sold, when we actually sell them, it's a cash inflow, and that's going to be to operating activities. When they are purchased, they represent a cash outflow from investing activities. Any unrealized holding gains or losses flow through net income and must be reversed. That's the next thing that's different. Because when we record these gains or losses, they are not going to be they are not going to be cash-based, but they will increase net income. So it represents a sort of gain or loss that we don't want influencing net income until they're sold. And there's one issue here. When they're purchased, they're even considered operating activities. Something that changed recently. So operating activities when they're purchased, operating activities when they're sold. It's an oddity. I know it's an investment, but because they're bought for short-term gains and losses, we treat them as an operating activity. Okay. So again, let's look at Crisco. Same facts, right? Well, we have a debt investment, trading securities, $1 million face value, cash, present value, discount is the same, right? Recording the interest, nothing's new here. Cash of $95,000, interest revenue of $98,105. The discount is reduced by $3,105. Same thing. Now we get to the year end. this is when we have a mark-to-market issue, because we care about what the market value is when it's a trading security. We didn't care when it was a held-to-maturity security because it didn't matter. We didn't want to reflect a market value. We just wanted the amortized cost. So remember now, we're wanting to adjust the carrying value, which is the face value plus or minus whatever discount or premium we have. And remember, we also just made an adjustment to carrying value by amortizing the discount. So we have to make sure that we're dealing with the appropriate carrying value. Remember that that carrying value was, after adjustment, $984,151. So that is my carrying value. And that is at 12/31. 15, I believe I'm working with. Nope, 16. We compare that against the market value at that date as well. So we have to have our ducks in a line here. We have to have the values at those dates be matching, right? So the market value we want is 992, which means that I want to show a gain, right? I want to increase the carrying value up to this market value. So we have 992 less 984. That's going to create a desired balance of 7,849. This is the amount of an adjustment I want to bring my carrying value up to my market value. And why that I call that then a desired balance is because we have a new account. I know you're excited to meet a new account that you're now going to have to keep track of. And it's called the Security Fair Value Adjustment Account. Security Fair Value Adjustment Account, or just Fair Value Adjustment Account for short, however you want. But the idea is that we have now 3 accounts, right? We have the investment in trading securities, it's at $1 million. We have the discount for the trading security bond that we just marked, and after we amortized it, it's at $15,849. Those two, when added up, because we take that and subtract that, give me $984,151. But we want to add now one more account, Securities Fair Value Adjustment Account for trading securities. This is going to be an adjunct account to the investment, and we now have established that we want a $7,849 balance. So it becomes, again, one of these balance to get an adjustment scenarios. Say we just bought this, which we did. It started at 0. So now we need to know what to adjust it by to get to that balance. Well, we're going to make that adjustment with debiting Securities Fair Value Adjustment, trading securities, for $7,849. So that then plugs this number into my account and gets me my desired ending balance. I told you it would be coming up again and again and again, and I'm not a liar. And it'll continue to come up in financial accounting too, or in intermediate too. So what do you think the credit is? What did I call this before? It would be an unrealized gain of $7,849. Right? This unrealized gain would flow through net income because it's a trading security. So that's how we would record the mark-to-market effect. So income statement effects, we have 2 this time. We're going to have the interest revenue that we recognized under the held-to-maturity scenario. That still remains. And then we're going to have the unrealized gain of $7,849, and that interest revenue was $98,000. 415. And then the carrying value on the balance sheet is going to be 984,151 plus this new adjunct account. So it's 1 million minus this plus this gives me 992, which again is just the market value, right? We've just replicated the market value with all these accounts. All right. So that is trading securities. Let's look at available for sale securities. Same process, same stuff. The only thing that changes now is that instead of NI, it's OCI. But I want to walk it through an additional year just so that we see what will happen when we do have a balance here. So the available for sale, right? They're not HTM, they're not trading, they're somewhere in between. The balance sheet treatment is going to be same stuff, an investment account at the face value with any premium or discount. It's going to require a year-end adjusting entry to report at market value. Remember, that's that mark to market effect. With regards to the income statement, we will have interest revenue. That's going to be the effective interest rate method, just like we saw with HTM and trading securities. Realized gains and losses will affect net income. So that means they actually do have to flow through after sale, but unrealized gains or losses are going to be to comprehensive income only, not to net income. So we have an unrealized holding gain or loss in the comprehensive income account. And remember that that still will affect overall equity because it affects equity by the accumulated other comprehensive income account when we close the gain or loss to the accumulated account. In terms of cash flows, these are a little tricky too, a little different than HTM and trading securities. Again, the inequality between cash and interest payments will have an effect to the cash flow from operating activities because the interest revenue will not coincide with the cash flow when the market and stated rates are not equal. When they're sold or when they're purchased, they are investing activities. They're not odd like trading securities. The purchase or sale of these are considered investments. When they are sold, any cash inflows, did I just repeat that twice? Yes, I did. Okay, so that says the same thing. Unrealized holding gains or losses do not need to be adjusted, unlike trading securities. The reason being is that the reason we adjust a trading security is that those unrealized flows affected net income but had no cash. So we back them out of that to get cash flow from operating activities. However, here, they do not affect net income. Since we use net income to derive cash flow from operating activities, there is no effect to it. We don't have to back them out. And that's it. Okay. So looking at the treatment, again, same thing. Now we're just talking about AFS, not TS or HTM. Same recording of the interest revenue and the amortization of the discount. I'd say at the end of the first year, suppose that the market value is 960. Well, if the market value is 960 and the carrying value at the end of the first year is 984,151, then we have a different desired balance. In this case, it looks like we're going to want to have a loss, right? So 984,151 minus 960. Oops. Is going to be 20. I don't even know why I used the calculator there. It's going to be 24,151. So we have a security fair value adjustment account for AFS that we want to have a debit or credit balance. Now remember, this balance is going to be something that we want to decrease the carrying value to the market value. So in that case, I want a debit balance. It starts off at 0, which means then that my adjustment here has to place the credit appropriately to make that balance happen. And I would debit an unrealized loss of that amount. That unrealized loss is going to OCI. Income statement effects, we would have interest revenue. That goes to net income. And then we'd have an unrealized loss of $24,151. That would go to OCI. So if you don't designate, I will assume you mean net income unless you state OCI, just so that we get on common terms. Again, the carrying value on the balance sheet is going to be $960,000, and that's going to be from the confluence or the three-way streamlined effect of the investment account, the discount on that investment account, and the fair value adjustment account. They all come together to give me $960 to record the second interest payment, right? So now we're jumping ahead to the next year so that I can show you what happens when these guys change. So we're going to want the interest payment for 12/31/17, which we hadn't journalized yet, but I have it right here on this amortization table. So we record interest revenue, $98,415. I record a cash payment of $95,000. And then the amortization would be the difference between them. The discount would be decreased by $3,415. Well, that means that this discount account, it was at $15,849. If we reduce it by 3,415, then we will have 4, 3, 4, and 12. Making sure I don't have to borrow. So 12,434 is my new discount. That means that the carrying value is going to be 1 million minus that discount. Notice I always like to take you back to the T-tables because I feel like you just never get enough freaking experience with them. And a lot of you don't seem to either trust them or want to deal with them. And I don't know, it's not helping you, that's for sure. Right. 984,151. The market value I said is at 984. Which means that we want a loss now of simply, I'm sorry, it's, sorry, totally miswrote what that subtraction is. It is 987,566. Okay, this guy right here. I took this one, which was our first interest payment. This is our second. All right, so the difference between these two guys is 3,566. That's going to be my desired balance. Well, is it, am I increasing my carrying value? Am I decreasing my carrying value? I'm decreasing it by 3,566, which means that this is going to be a desired credit balance in my fair value adjustment. Now, I did this one on purpose because I want to show you that even though we're at an overall loss, we are going to report an unrealized gain. The reason why we're reporting a gain is because we go from a huge loss to a lesser loss, right? So then what is the adjustment I would make to this account? It would be 24,151 less, plus 3,566 or 151 minus 3566. So it'd be 20,585, right? In order to get to this overall loss. So I'm actually going to want to record a debit to my security fair value adjustment of 20,585, which is an unrealized gain of that amount. Right. Ignore the fact that we're still at an overall loss. We transition to a lesser loss. So we have two effects of interest this time period. We would have the $98,415 of interest. And then we'd also have the new one is going to be our unrealized gain. That's going to go through OCI for 20,585. The carrying value on the balance sheet is going to be $984,000, which is its market value. And again, is the confluence of those three accounts. Okay. So go through this stuff, work it through a couple times, get a hold on the accounts, figure out the time value of money. You know, like I said, I know this is a really quick pace, but it's the pace we got to set to get through the rest of this stuff. See you in class.